Guys, there are 3 stocks selling near their 52-week low. Let's check them out right now. Stock number 1, ULTA Beauty. Guys, this is a stock that I own. Mo, do you own this?
No.
I own it. Don't buy anything just because somebody on the internet owns it. But look at this. It's down another 1.8% today, $6.60 today, down to $3.63. Guys, just to show you the volatility in markets. This is a great company. I'm going to show you more data on that here. It was at $5.74 4 months ago. Yeah, Mo, thank you.
That's a big drop.
Yeah, it's $210 less off of $5.74. That's almost, what, 40% almost? It's 30% at least in the last 4 months. Stocks can surge, stocks can fall. You saw a surge up here, a surge back down. These things happen all the time. All the more reason to be patient with things. Great company. Here's why, Mo. You ready? $17.6 billion market cap.
Okay.
Look at this enterprise value. $20 billion for a retail company.
Pretty good.
Yeah. Guys.
Usually it's way higher.
Way higher.
Or way bigger of a spread between market cap and
percentage-wise.
Yeah.
Now, the one thing I'm not a huge fan of is just last year's free cash flow is $915 compared to net income of $126. But their free cash flow over 5 years is very similar to their 5-year net income. And they're really increasing this, okay? That's another exciting thing. No dividend, which I love. And look at this return on invested capital.
It's very big, almost 30%.
Guys, if you're new to the channel, this is a very important metric for value investors. It basically shows the company's ability to basically be a moat. If they're able to get a high return on the money invested in the business, that's what you want to see. For a retail company, this is awesome to see. Great, great company. Okay, what are the pillars telling us? What's the story behind? This is an 8-pillar thriller.
Wow.
All right, we have a 5-year P of 19.5, 5-year price of free cash flow of 20, bought back 14% of its shares, low debt compared to its free cash flow growth, 377. Everything is a check mark. Everything is a check mark. So what this is telling me basically is, Paul, the numbers look pretty good. The question is, this is retail. Retail can be kind of hard. It's going through a very big transition right now. But let's look at their whenever it comes to retail, Mo, what do we always look at?
Same store sales.
Yes. Do you have this data?
Nope.
Luckily for you, I do over the last 8 quarters.
Boy.
Who's a good boy?
You.
Who's a good boy? So I'm going to show it to you right now. So here are the last 8 quarters of same store sales, in addition to their earnings per share in the last 8 quarters. Mo, hit me up.
1.6, $6.47.
Last quarter, they did 1.6% same-store sales growth. Then what?
2.5.
Yep.
$8.08.
Wow. $8.08. Next.
4.5, $5.07.
Okay. Next.
8%, $6.02.
Yep.
9.3, $6.88.
Next.
15.6, $6.68.
Next.
14.6, $5.34.
And the last one?
14.4, $5.70. Wow.
So remember, this is coming off the year after the opening of the market. So these same store sales growth makes sense. And it is declining now, which I do acknowledge. But remember, guys, this is a company that appeals to women, and women love ULTA Beauty. And ULTA Beauty is starting to enter into Target.
Oh, really?
Oh, yeah. They have I've been at Targets that have ULTA Beauty. They're making these strategic partnerships, which I love. Here are the number of ULTA Beauties in the United States from 2011 to 2023. Big increase and a little bit more flat. I like this because retail is changing. You got to be more strategic about your storage. You have to be smarter about it. Now, they are a great repurchaser of shares. They're very big on cannibalizing. Now, I'm not going to comment on do they overpay for shares or not, but remember, the key is you have to buy back inexpensive shares to truly add shareholder value. That's what's key. In 2021, 22, and 23, here are the shares they bought back. 475,000 shares in 2021, 115 million. 4,250,000 shares in 2022 at $1.5 billion. 2.2 million shares in 2023 with a $900 million expense. Now, guys, when a company buys back their shares, the net income, the free cash flow, everything else keeps going. But the number of shares it's split amongst is less and less and less. Now, Mo, look at this. Net income on the company from 2011 to 2023. Would you have thought there was a problem with retail sales?
No.
With brick and mortar retail sales based on this?
Not if I looked at this.
All right, so let's see what analysts are saying about ULTA. EPS growth, look at this. Almost basically double digits every, whoa. 26 up to 43 in the next 4 or 5 years.
Makeup is back.
Makeup is back. Now remember, Mo, that these are analysts, and analysts have their own biases, so let's make sure we remember that, but it's still nice to see that kind of growth. And look at the revenue growth. Mid to high single digits, 11.7, 5, 6, 6, 7, 6. They're going to open more stores. They're going to have same store sales growth. It's all going to couple together for more and more revenue. What is the right price to pay for ULTA Beauty? Well, I'm going to pull up my last time doing ULTA, May 23rd of 2024. Mo, here's my 10-year assumptions. Tell me what you think about these assumptions. 3, 5, 7%.
I agree.
You concur.
Yep.
9.5, 10 1/4, 11% profit margin.
I like it.
I did the same thing for free cash flow, even though the 10-year and the 1 year a little bit lower. So I probably should go a little bit lower, but I'm going to assume this comes out to the end same. Now, because of its high return on invested capital, that's increasing, by the way. Greatly increasing. I put 15, 18, and 21, and I didn't do as high as I usually would because it's retail.
Yeah.
I don't know if it's the right thing or not. And of course, I did my 9% desired return. Guys, this is 9 or 10% is the market average. I'm doing this to determine what the value of the stock is. This does not include my margin of safety, and you must include that because we're humans and make mistakes. Hit the analyze button. Boom.
Oh, wow.
I have a low price of 341, high price of 660, middle price of 476. If I pay today's price and all of my assumptions come to be true, I'm going to make 12.8% on the middle assumptions. I mean,
nice.
It's a pretty good return if you ask me.
It is a good return. No margin of safety, but great return.
Right. Well, now there's a margin of safety at paying today's price.
That's true.
I wonder, is this enough margin of safety? 12.5%, 12.8% return. So guys, I've bought ULTA. I'm going to continue to buy ULTA as it falls. That doesn't make me scared. It makes me excited to think, what if ULTA falls to $200 a share? As long as the thesis is the same, I'm going to continue to buy the company. And that's what's key for you to understand as an investor. Stock number 2, Nike. Mo, look at this. 52-week low just hit today. $70.91. It finished up today.
I will say, on a show this morning I was listening to, somebody said it was 70, and I'm like, what?
Yeah.
Nike? 70?
Yeah, because remember, what was the all-time high? Do you remember?
180?
Yeah, 179 and change. 179.10 back in November of 2021.
And this is Nike, for God's
sake. And this
sakes.
is Nike. Again, you got to be patient. It's over 2.5 years ago, but all companies will fall at some point. I don't care which one it is. It's absolutely impossible to sit there and avoid the fall. Berkshire Hathaway, in the time that Munger and Buffett have owned it, have fallen by 50% 3 separate times. And talk about a great company. Yeah. All right. You sit here, you have a 2% dividend. Okay. Eats up $2 billion of their $6 billion last year in free cash flow.
I feel like they could be doing something better with that $2 billion.
Especially when their price of free cash flow now is under 20.
Yeah.
I mean, I'm looking at this going, guys, what are you doing here? By the way, isn't it funny? ULTA has a higher return on invested capital than Nike.
Almost double, actually.
No, 26.
Isn't it 30?
No, it's 26 on the 1 year and 23 on the 5 year.
Okay.
Yeah. So that's pretty incredible for Nike. A lot of revenue growth. They have a lot of ambitions. I'm hearing people on that tweet telling me, Paul, I think Nike is no longer a moat. And I'm like, gee, I just think Nike is a moat.
I agree.
This is not me saying it as my bias. I have Nike stock, and again, don't buy it just because I do or anybody else does. We're here to teach a process. But I look at Nike, and I sit there, and that's what's great about investing. Everybody can look at it differently. You got to look at the breadth of business that Nike has. I mean, they're in so many things, and they appeal to so many different crowds. Yeah. That's what's incredible about Nike. They're all over, and yet they feel very niche in a way, don't they?
Yeah, very much so.
Like, it's not like, they're so big and so worldwide. If I asked you to name the number 1 apparel business out there, most people are going to say Nike, right. I think. So here's a company that's fallen from grace on stock price, $180 a share down to 71. And I'm hoping that continues. Look at it year to date, down 33%. 6 month down 29, 3 month down 24. I mean, everything until a 10-year mark is down. Even the 5-year mark, down 18% from 5 years ago. 18%. Now you got the dividend along the way as well, but still. Okay, let's look what the 8 pillars are telling us. Here's the story of the 8 pillars.
Whoa.
Yeah, seven checks.
I expected 6.
I expected 8.
Oh,
Yeah, I totally forgot that the 5-year free cash flow is a little bit under the 5-year net income, but it's pretty much there, right?
Yeah.
Net income growth. Look at the free cash flow growth in the last 5 years: 2.8 billion on 10.3 billion in revenue. Low debt. There's that $13 billion in net debt. Get a high return on invested capital. I'm glad they're not buying back a bunch of shares before, but Nike, you might want to consider buying back some shares soon. I think this is the start of it. I look at Nike going, I look at these prices saying their job is a dollar cost average into great companies. And I'm looking at this thinking to myself, okay, this is a great conversation to happen in the community. Like I look at our community and think to myself, like, what are we having conversations about if it's not Nike? If we're not talking about, listen, the ability to buy phenomenal companies at phenomenal prices is going to happen very rarely, usually when markets are crashing. We're not crashing yet. Or maybe we don't crash. But at some point, if all the markets go down, they're going to start selling off every company as these ETFs get sold. It's going to drive Nike down. This is why you need to have a conversation in our community. And if you're not part of our community, you may have noticed that we are limiting the number of daily spots for everything money, community, and software. And the reason for that is the software that exists today currently includes everything we have to offer for stocks, retirement, and real estate. All of these tools. Now, behind the scenes, though, we're making some very big changes. So that current offer of everything is going away very soon. As we've grown, we've been getting feedback from our community, and they've expressed that they want us to focus on specific aspects of the Everything Money tools that apply to them at that moment in time. Since we don't want to be the cheesecake factory of software, we've decided to limit the tools offered very soon so that our users are not inundated. And you'll remember, if you've been watching us since we started, this software was originally built for Mo and I, and that's it, so we can make better decisions. But as times have changed, our channel and community have grown immensely, and since then, it's becoming less about me and more about how I can better serve you and the community members. So the good news is these changes haven't been made yet. So if you join today, you'll be grandfathered in for life with all of these tools and every tool we make from here. This is the best deal we have ever offered. So if you're really serious about making better financial decisions, increasing your returns, and sleeping better at night, click on the link in the description below to get access to everything we have to offer before we make the changes. And I'm very confident it'll be the best decision you've made all year. Now, what's Nike worth, Mo? Why don't you pull up your stock analyzer on Nike?
I just want to say about the share repurchase real quick.
Yes.
$18 billion program was put into place in June of 2022. They have repurchased $8 billion under that program, so $10 billion to go.
$10 billion at a much lower price.
Mm-hmm.
Mo, what'd you do for your Nike 10-year analysis?
2%, 4%, and 6% revenue growth.
Okay, I had 3, 5, and 7.
Okay.
What'd you do for profit margin?
It was pretty tight, actually. 9.5, 10, and 10.5. It's been extremely consistent.
It has been. Now remember, I actually put 10, 11, and 12 for both because they're doing more direct-to-consumer sales and cutting out the middleman. So I'm imagining it's going to help their margins. Okay.
Free cash flow margin, I did my same numbers.
Yep.
9.5, 10, 10.5. PE and price to free cash flow, 18, 21, and 24.
Really? That's it? Nike?
I also did 2% revenue growth with 9.5% margins.
Yeah, I think you really beat it up.
If that happens, I'm not willing to pay that much of a premium.
I did 20, 23, and 26.
You know what I'm saying?
I don't agree with that. I think to myself, if they had this low revenue growth for a while, it's only because of their size. And I don't know. I just think maybe you're right. Maybe I have my bias of Nike because I do love Nike.
Yeah, I do too.
And you did your 9% return?
9% return.
So what were your values?
51 on the low, 92 on the high, 69 in the middle.
All right. I did 61 on the low, 120 high, 86 middle. Paying the current price, including all dividends, you'll be collecting about 11.6% internal rate of return.
You own this?
I do own the stock and I want to buy more. And I'm probably going to sell puts at lower prices. Third stock, UPS, fell big yesterday, Mo.
Yeah, it was like 12% or more.
Something crazy like that because they missed out on things showing a weaker outlook in the future. The stock is currently at 127, all-time high of 233. Oh, wow. Back on February of 2022. Decent return on invested capital, 5 years, 18.6. So actually higher than Nike. Mm-hmm. Free cash flow, 5.6 last year versus 5.9. 6.8 5-year free cash flow versus 7.4 billion, 5% dividend yield.
Dividend they pay?
Yeah, the dividend's big.
It's almost all of their.
That's the
12-month
problem.
Free cash flow.
That's the problem. And it's not like they have little debt. 155 to 109.
Yeah.
It's not like it's a small amount of debt. Profit margin was low last year. Gross margin 18%. 3-year compounded revenue growth basically flat. This is probably the hardest one for me to get my arm around. Let's go to the 8 pillars and see what's going on here. So the only X we have here, Mo, is the debt.
Mm-hmm.
But I think the fact that, so the question is, Mo, is this dividend safe?
I mean, technically they can afford it.
Yeah, but they're already talking about a weaker environment for them in the future.
Well, then no, it's probably not safe.
Okay, so let's pull up some data here that's pretty interesting.
Even if you cut it in half, it's still a good dividend if you insist on paying it.
Yeah, I agree, but people hate dividend cuts.
Do. Yeah.
U.S. domestic revenue in 2023, $60 billion, $17.8 billion international. I don't even know what supply chain solutions are, but it's $13 billion. Look at this dividend history. That's why I'm not going to cut that shit.
Yeah.
Total revenue year over year, 97, 100, down to 91 last year. Okay, let's see some more data here. As you can see, this is the package revenue for domestic, and this is the first fall in a while. We don't see one back here. This is the revenue, down 60 billion, down to 60 billion. What was that?
It's a big fall. It's not just a little.
Yeah, it's 6 or 7% fall in domestic, and I gotta think the U.S. makes up a big chunk of this. Here's the, don't look, Mo. 21.2 billion in U.S. shipping and delivering package volume units in 2022. 21.2 billion units.
Okay.
How many did UPS have?
7?
No.
Okay.
4.8 billion.
That's it?
United States Postal Service was almost 7.
Oh.
Amazon was bigger than that, 4.2. And FedEx was 4.1, and other was 500 million units. Now, national shipping and packaging delivery, this is not about UPS, it's about overall national stuff. The average American household received 162 packages in 2022, down 2.4% year over year.
Wow.
Now, they're coming off the year off of COVID. There's a lot of things. 166 parcels per household in 2021. Americans received packages at a 55% higher rate than the global average. Makes sense, though. Parcels per person declined 2.2%. The average cost per package was $9.33 in 2022, up 6.75%. And from 2017 to 2021, the average cost per packaging increased 8.34%. So there's a lot of tailwinds for the ship, especially as we do more and more shipping for more and more online buying, things like that. Is this a question of the fact that it's just a temporary fall in shipping? Because is the consumer looking weaker than people want to give it credit for? Now let's go see what analysts are saying about UPS. EPS growth. Oh, look at this. Oh, it's 830, 992, 1147, 12.8, 14.
Based on the numbers I'm seeing, I wouldn't have guessed this.
I would not have guessed that either.
Okay.
Would not guess that either. Revenue growth, 4 or 5%.
Yeah.
5.9, 5.6, 6.7, 5. So 5 or 6%. All right. Not bad. Not bad at all. Now, what is our stinky little thing? The UPS, the Brown Company, June 3rd. Mo, here are my assumptions. I did 2, 4, and 6% for the next 10 years.
Okay.
7.5, 8.5, 9.5 for profit margin. Free cash flow, it's always lower. So I put 6.5, 7.5, 8.5.
Okay.
15, 18, 21 for PE and price of free cash flow. Guys, don't forget all these tools. Click on the link below to get all these tools and the community before it goes away. Hit the analyze button. I got a low price of 100 to 112, high price of 211 to 236, middle price of 144 to 164. For me, I'm waiting a little bit longer. Guys, if you want to watch our previous video on the 3 stocks at 52-week low, check out that next one. Thank you very much for your time.